G'day folks, and welcome to a Check on Chain update for the 17th of September. Now, this is a report that I've had on my to-do list for some time, and really the question that I set out to try and answer is how often does Bitcoin go up, down, or sideways? Because as you probably experienced, probably even with my analysis, but with anybody's analysis, the general theme is it could go up, down, or sideways, right? And that's kind of the three combinations. But the question is, why is it that we always end up in this kind of framework where we're going, well, why does it go one of those three directions? I know that's the only place it can go, but why is it that it always kind of seems like it could go up, down, or sideways at any point in time? Now, that's one thing to really understand the probabilities of this, but then again, with all these things, what do you do with that information? And really, this is, I think, a great piece to help. It certainly helped me, actually. I've got my own personal strategy for how I dollar cost average in a Bitcoin. Generally speaking, I would frame it as I'm not going to buy when the market's overheated. I'm going to try and buy when there's blood in the streets. But my general thesis is I want to be stacking as many sats as possible and just hodling them. That's more or less my overall strategy. So there's a buy side component to that, which is looking for dips, but there's also just sitting in the market. Now, that sounds like a decent strategy. I'm sure a lot of people probably have a very similar one, but going through these kind of mechanics of understanding what is the probability on the daily time frame, what does it look like on the monthly and the quarterly time frame, understanding this thing that I'm going to call the HODLers Advantage. These are some of the things that you'll hear about DCA. Why does DCA work? A lot of the statistics and mechanics of why DCA is generally speaking the best strategy, you're actually going to find from going through in this report. So let's get stuck into the charts, because I think this is a really interesting study and probably actually relates to a lot of us and the way we kind of think about and consider our holdings. Let's get stuck into it. Alrighty, so the first thing I want to start with is just understanding this concept of timeframes, because in all kinds of market analysis, timeframes matter. What we see on the daily chart and the hourly chart often is indistinguishable from complete and utter chaos. And as you'll see in about a chart or two charts time, that is pretty much exactly what it is. It is complete and utter chaos, and it's really a coin flip. It just happens to be a three-sided coin. Now, what we're looking at here is the number of consecutive weeks. So we're looking at it on a weekly basis. How often does Bitcoin go up one week, up the next week, up the second week? That would be a series of green consecutive weeks. And obviously in a downtrend, you're going to get red consecutive weeks. And what you'll probably notice on our scale bar down here, let me actually just put this onto a scale of 10. On our scale bar, very, very rarely do we get more than 3 weeks consecutively in either direction. More often than not, it's green into red, red into green, green into red. It is choppy as anything, right? And you can actually see all through this bear market, there was plenty of 3 weeks on the upside and then weeks on the downside, 3 weeks on the upside. This is that choppy style behavior. So the real takeaway here, yes, we get bursts of like long multi-week trends in bulls, long multi-week down trends in bears, but for the most part, on the smaller time frame, and this is weekly, so this is not the smallest time frame, on these smaller scales, it is already looking quite choppy. There's a lot of green becoming red, red becoming green. This is kind of the default as you get higher down or down into lower time frames. Now, if we zoom out and look at this on a monthly basis, the more you zoom out, the more you take out this kind of daily noise. Now, from this perspective, bull markets really do stand out, and so do bear markets, right? Multi-months of downside, multi-months of upside. Now we can see that in our current environment, it's literally red, green, red, green, red. This is chopsolidation, right? It is quite literally going 1 month up, 1 month down, 1 month up, 1 month down, but we can start to see these big picture trends. And when we look at these chopsolidation periods, here's another one back here through 2019, right? Chopsolidation back here. During this process down the bottom here, we had red interrupted by green. Again, choppy periods. This is typical. We actually see a lot more of this than you might expect. And that's what we're now going to jump into and start looking at some of the probabilities of this stuff. Now, for the rest of this piece, I'm going to define an up day as a day where we see more than 1% return. A down day is less than 1% return. And what I'm going to call a neutral day is it's between plus or minus 1%, right? If you wake up and you see Bitcoin's plus 0.4%, you probably don't really care that much. If it's down 0.5%, it's okay. If it's up 4%, now you start paying attention. So what we're looking at is the distribution or the population of all of those one-day returns. Now notice that we don't have that many 10% days. We've got some of them, but there's not a huge amount of these like 10% days. Most of our candles that we see plus or minus 2%, but actually when we look at it from a 1%, taking that neutral bound, something like 33% of all days have a sell-off more than 1%. 33% of all days have a rally more than 1%. But the remaining 33%, or 1 in 3 days, is between plus or minus 1%. In other words, in any 3-day period, at least one of them is going to do absolutely nothing. This is probably slightly larger than a lot of people expected. I know that Bitcoin chops around, and my instinct was that this chop solidation is actually a lot more prevalent than people realize. And I think the first counterpoint that most people will come to is say, hang on a second, but if this is looking at all data, surely all the bear markets, there's going to be more down days, and in the bull markets, there's going to be more up days. Now, you are correct on the margin, but notice how the shape of these 3 curves, bull markets, bear markets, and just all markets in orange, they're pretty much the same curve. We're talking about plus or minus 3, 4, 5%. Generally speaking, 1 in 3 days is a sell-off more than 1%. 1 in 3 days is a rally of more than 1%. And the other 1 in 3 days, we go absolutely nowhere. So now let's put yourself into the shoes of a trader. One of these day traders who wants to get in and chop around in the range. You're going to go long or you're going to go short. Well, you've only got a 1 in 3 chance of being right during the course of that day, right? You are flipping a 1 in 3 coin. Now, if you think about how odds and probabilities work, this is how casinos work, by the way. They essentially go, hey, we've got 2 out of 3 odds that you're going to be wrong. It's going to go sideways and frustrate you, and you'll sell the position out of just annoyance, or it'll go in our favorable direction. If you run that experiment where you have 67% odds as the casino, you play that game all day. If you've got 51% odds and you play that game over a long enough time frame, you're eventually going to come out on top. This is quite literally how casinos make their money. So if you're a trader, you're a day trader, and you focus on that small time frame, you have a 1 in 3 chance of being correct. Options traders, in theory, they can capture this sideways. It's a complex strategy, but they can capture the sideways behavior. But really, at the end of the day, most people have about a 67% chance of getting blown up. This is why liquidations happen all the time, because traders, the odds are not stacked against you on the daily time frame. This is a really, really important point, because we're going to come back to this chart just shortly on the monthly and the quarterly, but I want to just really nail in this point that for the most part, Bitcoin goes absolutely nowhere. And this is why a lot of traders blow themselves up, because they actually have the odds stacked against them. Now, what I've done here is taken a 90-day window, and I've basically summed up out of that 90 days, how many of those days are one of those neutral, minus 1 to plus 1% days, meaning Bitcoin went nowhere. Now, over on the right-hand axis here, somewhere you can kind of see the middle, right? You'd kind of put the middle of this chart here, this blue line, that's 30 days. That's 1 in 3. Right? If we're talking about a 90-day window, 30 days is 1 in 3. Up the top here is 60 days out of that 90. So somewhere in any point in time, there's occasions where we rally, there's occasions where we sell off, there's a couple of points in time where the market trends that we saw in those first charts. But for the most part, these neutral sideways, less than 1% in either direction days account for between 1 in 3 and 2 in 3 of all trading days. Kind of amazing, isn't it, when you realize that most of the time, Bitcoin does absolutely nothing. Now, strangely enough, in our current environment, we're at 33. So only slightly above that 1 in 3, but it feels like we've been going nowhere forever. But it's actually very, very, very normal. Kind of a very strange dynamic. Now, there's another one here. I want to look at the amount of up days, right? Days that are more than 1% versus down days. Now, this is looking at on net. So let's say that we have 30 up days, 30 down days. They're going to neutralize to be a value of 0. So when we see these red values, right, minus 19, that means there was 19 more down days than up days over that 90-day period. So it's like a net balance of how many days do we go up or down. Now, you would kind of intuitively think that surely we have the most number of down days during the 2018 bear, the 2022 bear, and we do. We have a handful of net down days. However, 2019, we have a lot of net down days, and this was chop solidation, right? Yes, it was trending lower, and yes, you can argue this was a bear market, but it wasn't anywhere near as severe as this, right? 20,000 down to 3,000, 14 down to 8. It just doesn't have the same kind of magnitude. And right now, right, we are 22% off the all-time high. It feels awful. And that's because there's actually a lot more down days during these chop consolidation periods. This is just another example of 2019 showing up as by far and away our closest analog. You could argue that the sell-off in 2021 was similar, but isn't it funny that we actually don't necessarily get the most balance of down days during bears? Now, this is in part because, and this is a fundamental market principle, something that I've certainly come to realize, quite often the strongest uptrends are actually inside bear markets because human beings have this natural gravity where we want to be long. We want the asset to go higher. We want to buy the bottom. This is like a very natural thing. So we can create these very strong impulses. I remember learning this all through 2018. I bought many of these tops because it felt great at the time. Very, very powerful. We're back. It's finally back on. It wasn't back on, and it didn't feel great after I'd bought because the market sold out from under me. So this is one of these great examples that we actually get a lot more of these down days during chop consolidation periods. And that's a lot of the reason why it feels bad. It feels so exhausting and overwhelming. We actually have a larger number of down days, but they aren't quite of the magnitude that you get in a bear, right? This is just looking at the number of them. Obviously in bear markets, you'll get big negative 10% candles. Here we get -5 followed by an up 3 and then -2 and then a -4 and then an up 5. This is the kind of that choppy behavior, but that frustration is what shakes a lot of people out of their position. But I thought this was just a kind of an interesting psychological framework to think about these things. Okay, so just to really summarize where we're at so far, we've looked at the day, basically in the daily time frame, flip a 3-sided coin and you'll have about as much chance as a day trader. When you look at things on a zoomed out perspective, right, we do expect there's this kind of balance, but at the same time, we saw that there was those trends on the monthly time frame. We start to get a bit more of a clearer picture. Now, this is the same chart, except we're looking at a 30-day window, not one day. We're looking at what is the price return over any monthly period. Now, because I'm using a rolling window, this is not saying like, how'd you do in January and February and March? This is just saying, if you were to allocate at any point during a 30-day window, how would the next 30 days return look? Now, what's quite interesting here is note we're getting a bit of a divergence. If you remember our daily chart, all these S-curves were pretty much overlying each other, meaning it's basically a flip a coin and you'll see which way it goes. On this side of the equation, when we look at it, if we're in a bull market, right, I'm just going to go from 0 here. If we're in a bull market, there's a 67% chance that we're going to go higher and you get a positive return. In a global market, there's a 56% chance. Again, remember, if you're the casino and you get 51% odds, you're going to win over the long term. Here, we've got 56% odds. And only in the case when we're in a raging bear market do we have that 1 in 3 odds. So what this is really telling you is that over a monthly time frame, right, unless we're in a really nasty bear market, the probabilities are actually more than 50% and up to 64% that the market wants to go higher. You can actually see there's like this positive skew. There's a big longer tail of positive returns. This is starting to get into the framework of the HODLers Advantage. This is why being in the market, this whole, you've probably heard the anecdote, time in the market beats timing the market. That daily distribution is people trying to time the market. Flip a coin, 1 in 3, doesn't matter if you're in a bull or a bear. Here, if we can use on-chain tools to say, I think we're in a bull market or I think we're in a bear market, we can now have a much better odds. If we just didn't even look at which kind of market structure we're in, we've still got more than 50%, 56. But if we can use those on-chain tools to really refine and say, hey, we actually do think it's a bull or we do think it's a bear, you can then really start to go, well, my odds are now much better. 64% is way better than 1 in 2, right? Certainly better than 1 in 3. If you're a bear, you can say, well, if we think we're in a macro bear market, there's a 67% chance we're going lower. You can start to really frame these things up. And this is ultimately what I think is the HODLers Advantage. Being in the market on the bigger time frame, generally speaking, has a positive skew. It tends to want to perform to the upside. Sure, these things take time and you've got to survive the chop consolidation, all these types of dynamics, but there is a net positive skew. Time in the market generally beats trying to time the market. And let's take this to the next level and say, well, what happens on a quarterly basis? Look on a 90-day window, and our odds improve even more. There's a 75% chance that we're going to get a positive return during a bull market. During all markets, it's a 62% chance. Again, way better than 1 in 2. And we've got very, very similar odds for 1 in 3, essentially, for the bear in order for it to go lower. But then also notice at the far end here, we get up to 90% of all days. The last 10% of all trading days, right, in a quarter, 10% of those quarters are a plus 100% return. And by the way, this happens during bear markets too. Notice that bear markets, we actually still have these 100% rips higher. This is what I mean. These strong markets can happen during bears. So the takeaway here, there's a couple of things. First thing is that the hodler's advantage is time in the market. The other one is that there's a couple of days, right? Certainly over this side, there's a couple of days that really are responsible for some pretty major components of the return profile. So the final question I want to answer, what happens, right? If we're looking at this hodler versus trader mentality, what happens if I try and avoid the worst days? But what happens if I also miss the best days? How does my return profile change? How does it evolve? Am I better to just hodl? Am I better to actually try and trade this thing? Trying to just kind of wrap that all up and bring it into a bit more of an actionable thing to think about. Now, this funky looking chart, I'm going to look at 3 different time frames. This is 2019, then we're going to look at 2021, and then we'll look at our current market structure. Now, the white line in the middle is basically what happens if you had have bought and just hodled, right? You just buy Bitcoin, you just hodl over this period. What is your return profile? Now, I've got starred here in the green and the red. These are the 10 best days in green, the 10 worst days in red. Now, this is not a perfect model, but all I want to do is say in the green and the blues and the purples, we're only going to focus on the green and the red just for simplicity. In the green profile at the top here, this is your return if you avoid the worst 10 days. So you eliminate these red stars, you're not there for it, you've built the persona for this green line, someone who's got a very advanced algorithmic quant model, and they spend all this time and capital, and they just perfectly picks the 10 worst days and gets out right before them and then gets back in, right? So kind of in that algorithmic trading sense. The red curve down the bottom here says you missed the best 10 days. Now, I would equate this, and I'm sure you've all heard this before. You speak to some of your friends, right, or a family member, whoever it is, they probably don't know a thing about markets, and they sure don't know a great deal about Bitcoin, and the advice is almost invariably, but if you sell now, you can buy it back lower. And my personal answer to that is based on what? What is your edge? But nevertheless, I've received this advice from countless people. My job is to understand how this asset works. But of course, the guy who owns absolutely no Bitcoin is telling me to sell now because it's going to go lower and you can just buy it back at a cheaper price, as if that's just like an easy thing to do. Now, what I would posit is that here's one of those worst days. How does it feel on those really nasty sell-off days? For a lot of people, and we see this in short-term SOPR, they go, I know, I'm going to sell now and buy back later. And what they miss is 1, 2, 3, 4 of the best days in that process. So think about this red curve as your mate who wants to sell now and buy back later. Again, it's a simplistic model, but the idea is that if you are trying to do this kind of day trading event, what can generally happen is you actually miss some of the best days. Now, let's go over 2019 and see how you would have performed. Well, if we look at it in terms of the 2019 market, you'd be up 220% if you just hodled. Now, you're up about 420% if you're Mr. Quant with your expensive model and you've done all these sorts of things. You're up about 80% more, right? Now, that's pretty good. You've almost doubled the performance. But at the same time, you can't be too mad at being up 220%, right? For doing very little, really, it's just kind of surviving. If you miss the 10 best days, you're down 45%. Now, what do I mean by down? This actually means that your holdings have gone negative because in theory, the up days have been so powerful that they've not only offset all of the down days, but they're also responsible for that 220% return on top of that. So that's just 10 days in the whole market structure. So if you kind of think about like for the average guy, average hodler, the probability that you're going to build a very complex quant-based, advanced, algorithmic, all that stuff, I would say most people listening to this probably aren't that guy. They probably know a lot of guys who want to sell lower and buy back later, but I would say you probably question whether that's an achievable thing. Now, for some people, this will make sense, and there's strategies and all this kind of thing. I'm not trying to say that these strategies don't make sense, but what I'm saying is that the hodler's advantage is in many ways doing absolutely nothing. And getting that 220% return, sure, you don't get the algorithmic guy by missing those drawdowns, but at the same time, you're also not negative on your capital. Let's look at the 2021 cycle, right? And again, I'm focusing on bull legs here because for the most part, well, 2019 wasn't really a bull, it was actually a bear. You're still kind of up in a pretty decent way. Here I've taken 2021 on the rally higher. And then, so this is post-COVID, right? In November. So Michael Saylor's starting to buy coins back here. And I've included the 50% drawdown, right? 1, 2, 3, 4 of the worst days in this period, all in sequence. It was like a 50% drawdown. So the average hodler is up 264%, right? From this November period all the way through, following all the sell-off, they're still up 264%. Mr. Quant, who's managed to avoid all those drawdowns, is up 480%. So kind of a similar delta in terms of outperformance. It makes sense. If you're avoiding all these nasty drawdowns, you're going to do much, much better. But then the guy who essentially tried to sell here and miss these good days, or sold here and missed this good day, he's actually only up 22%. So in many ways, by missing the 10 best days, even though there's a 50% drawdown, by missing those best 10 days, he's basically given back the entire bull market, and he's below his original cost basis. So again, pretty nasty stuff, right? At the end of the day, it shows you that those 10 good days actually do a lot of the heavy lifting. So let's close out with our current market, right? Now, this particular structure, we haven't necessarily, let's just assume, right, to be fair across the board, we haven't had like the big drawdown we had in 2021. We haven't had the big drawdown we had like in 2019. It's kind of also maybe because we may not get one, right? Let's also be careful here. It doesn't necessarily mean that we have to play out, but just to kind of frame things up. Now, if we look at our current market structure, we're up over 350%. Mr. Quant is up 500%. Again, a decent return, but so is 354. The hodler's advantage, they didn't have to build all those quant models. And again, that assumes that they work. That's easier said than done. So 354% from the from 1st of January 2023, and 120%, or actually up 30% essentially, is what's going on with the guy who missed any of these good days because he sold here thinking he was going to buy back later, and the market had a couple of good days. They sell at these points because they're angry. So really the core takeaway, or kind of the big picture as I wrap all of this up, the hodler's advantage in many ways is actually getting in at the right time. And when we see these nasty sell-offs, these worst days, the default, and I look back at my 2018 self, my default was I'm going to sell here and buy back lower. And what I was actually doing is creating a short-term SOPA print below 1 as I crystallized my losses and thought, don't worry, I'm smarter than Mr. Market. I'll buy back lower. I then miss many of these green days and buy up towards the high. And then, of course, the market sells off and I have another bad day, and then I do the exact same thing, right? Notice how many of these good and bad days are clustered. Same in 2019, clustered around the peak. These are those points when people get absolutely chopped up. And when I look at my personal buys over this exact period, I know that I've got buys down here. I know I've got buys not on the green, certainly on these reds, right? Which again, they're expensive prices relative to where we are now, but they're also not as expensive as these green lines, right? Or these levels where we get this August 5th sell-off. I stack sats here too. So the way that I personally have kind of shifted, and I didn't even know that this was what's going on, but this kind of helped me understand my own strategy and why it, generally speaking, seems to work. I am looking to buy on those worst days rather than be the guy who's selling and capitulating. I avoid buying on these best days. I want to be there for them. I want to have my position in play for them, but I don't want to buy into them because that's FOMO kicking in. Here, I actually want to be waiting and being bold and being brave and buying that blood in the street on the sell-offs. That's really what I want to be doing, because if I want to be there for the best days, I want to have bought my coins as cheaply as possible on the worst days to amplify those returns. So in many ways, I think the hodler's advantage is just being in the market, not trying to time it. You've got a 1 in 3 chance of being right if you're trying to day trade. If you zoom out and look at it monthly, quarterly, you greatly improve your odds. But then you add that extra layer and say, well, when these worst days come around, I want to be prepared for them, not scared by them, prepared for them. Some people can try and avoid it using complex algorithmic models, and that obviously gives some kind of a return. But ultimately, I want to just get up into this purple and this blue where I skip the worst 5 days or worst 10 days or worst 1 day, not necessarily by selling and hoping to buy back lower, but instead by optimizing when I buy. So I'm reducing my cost basis and riding the best days with a lower entry price, right? That's really how I personally like to think about these things. And it's, at the end of the day, this is why a lot of traders get blown up, because they're trying to bet in a market that's levied against them. Whereas if you go over the long term and you use that hodler's advantage, you really start to stack the odds in your favor. So anyway, folks, hopefully you enjoyed that one. Let me know if you've got any questions or comments. I know there's a lot of stats and probabilities and things, but if you've got any questions at all, you can always reach me and I'll catch you in the next one. Cheers.